Welcome, everyone, to the Directed IRA podcast with Mark Kohler and Matt Sorensen. We are absolutely delighted to be with you today on the Open Forum podcast. This is the People's episode where we are answering your questions.
Okay. I want to rearrange the books here. There we go. I think that looks better.
Okay. For those on YouTube, Mark has just covered my book with his crappy book.
Oh, what? I never said the word crappy. I was just, pointing out. So if you're on YouTube,
Yeah, this also functions as a coaster if you can't find any other valuable use for this. Maybe a paperweight.
Wow, boy, just one overt move, you're just fight back. All right,
defense mechanism kicks in.
Well, thanks everybody for being here. This is the Open Forum where we try to keep it light and interesting and fun, and we're going to answer your questions. We're pulling them from the website, directedira.com/podcast, and also Main Street Business Podcast. A lot of retirement questions are there. When we answer your question, we try to comment back and let you know the episode and date that we replied or commented on the show. We really try to get to all the questions. It's just sometimes takes a month or two. We should be in the studio more.
Yeah.
We should just be here more.
Yeah, we should just live here. I feel like I do already.
Yeah.
We do try to get to every question, but some questions suck. Guys, some of your questions are weird. I don't even understand them.
Wow, nice. Man, you're attacking my book and you're attacking our customers?
I know, I just came back from vacation, so I'm all like refreshed and ready to just
It's like, our listeners are dumb. I'm like, wow, you're going to lead with that, huh? Okay.
No, just, you know who you are.
What?
Actually,
wow.
The sad thing is they don't.
Jeez. Man, a little role reversal here. Usually it's Mark Kohler out there blowing it up. All right. Okay, well, let's start with question one here. I got a good one.
All right.
Okay, this is Lance. He posted it at mainstreetbusiness.com, and I've replied and let him know. This will be episode 76 if you're listening at Directed IRA. And so open forums, we just need to do more of these maybe. But anyway, love your questions, folks. Okay, Lance says, I'm wondering what the best way to invest in a startup is with my Roth. Should I set up an LLC to invest directly? Thank you for your time and consideration. Well, Lance, great question. I think that's a very smart and intelligent question.
I
agree.
I may say. That was a great question.
A great question.
I
Okay, give him some kudos. All right. But here's the thing. When you say invest in a startup, you're going to hate this. It depends. If it's your sister-in-law that's opening up a floral business down the street, we may help from the law firm side literally set up her LLC for the floral shop and make your IRA an owner of the LLC that actually owns the startup. On the other extreme, you might have a GoFundMe on the, or some PPM or some sort of Reg D offering. Grant Cardone's got another offering he's doing. He's on our show previously, and so your IRA may go directly from the offices at directedira.com with the subscription offering that they send over to the office. And then in the middle of all this, you might want to set up an LLC, fund it with your Roth, and then your little LLC can, bam, pull triggers and be a member of someone's LLC in a real estate deal or be a member of someone's new landscaping business. So it depends on the startup. I'd probably say unless it's really vanilla, like you're going to go into a hedge fund or some sort of PPM like a Grant Cardone thing, I would go meet with a lawyer. Just make an appointment with one of our lawyers and go, hey, I got this Roth money. I want to do some investing in startups. Tell me the best way. And it'll save you so much headache.
Yeah, and mostly if you're going through like Republic or you're investing in a startup that is like raising money, they're going to go be the next best brand new company out there. They're actually raising capital. They are a corporation or an LLC themselves. So like you don't need an entity for asset protection. The LLC is not going to help for that. You don't need an LLC for the checkbook because you're going to make a one-time investment into the fund, own the shares, and then the profits are going to go back when you sell it or there's dividends. So I probably would say you don't need an LLC. I love the LLC for people making lots of different investments. You got a rental property, you're doing short-term money lending, you want available funds. Like Mark said, maybe you're partnering in a small business, the sister-in-law, or whatever it may be. So so I would just think about that. Don't worry about the LLC, likely for the startup. That's my fallback, but you might need a consult if you're doing something interesting or you're doing lots of different deals where an LLC could just be more convenient for you.
I love it. I just replied to Lance here. You should get that ping, and you're off to the races.
All right. Mike's got a question. He asks, what happens to my 401k or my self-directed IRA when I retire, especially if there is a syndication in it? Okay. Now, this is just kind of similar to Lance's topic, but on the backside of the investment, all right? Let's say you've made this investment. You've invested in a private fund, sometimes called a syndication. Let's say this fund owns an apartment building. It's paying some rent, cash flow to you. But let's say the asset's worth $100,000. All right, well, you hit 72, you're at retirement age. And if you got a solo K or traditional IRA, SEP IRA, you got to start taking required minimum distributions. So now that you're in retirement age, you need to start taking money out. The IRS wants to start taxing this money. You've got all this tax deferral. So you've got to start taking RMD. Now, we do see clients have to do some planning here. And this is why this is a great question, Mike, because everyone needs to be aware of the planning that needs to take place. You need to make sure that the cash flow you're getting is going to satisfy RMD. Let's say you've got a $100,000 investment here in this, and that's what it's booked on your account. I would say RMD is about 4% a year. 4% a year on $100,000 is $4,000. So you've got to at least be able to have $4,000 that you've got to take out of the IRA as a distribution every year. Now, it goes up a little bit as you start getting older. In your 80s, it might be 8% or so. So know that RMD is going to keep getting higher and higher and higher. Now, if there's no distributions coming out, there's no cash flow coming out of this syndication, and you don't have other IRAs that you can satisfy RMD with, because that's another great tip. We've had clients that have self-directed assets that have no cash flow. They're appreciating in value, or they're still an asset they're holding. They're not wanting to sell. But you can satisfy RMD from other IRA accounts. Let's say you got a brokerage IRA account somewhere else at Fidelity. Well, you can use that IRA to satisfy RMD for the Fidelity account and your self-directed account. So know some planning needs to take place. Be aware that there are some RMD you have to take. And for self-directed accounts that are illiquid, you got to be ready for this. Now, remember, Roth accounts, Roth IRAs in particular, do not have RMD. Roth solo 401ks still have RMD, though. So don't think you're out of RMD on Roth solo K accounts. Only Roth IRAs are exempt from RMD.
Okay, I love it. Great answer, Matt. All right, I'm going to jump over here. I'm taking the questions from MainStreetBusiness.com. This is a good time to mention our sister podcast, Main Street Business. Some people listen to this Directed IRA podcast and didn't know we had a kind of a more general business forum podcast. It actually has more downloads and views. It's been around longer. Get over to Main Street Business podcast for just good business planning. Well, we have a section over there for retirement planning. And so we're just going to be filling in questions from both places. So here's from Joe Stafford down in Austin, Texas. Hey, Mark and Matt.
Great dude, by the way, Joe.
Great what?
I know Joe. He's a great guy.
Oh, really? Okay. Hey, Matt gave a little shout out there. There we go. Okay. I have a solo 401k plan I set up with you guys. We have a large amount of cash sitting in Wells Fargo in the Roth portion of the 401k. I rephrased this question a little bit so everybody understood that. They set up a solo 401k. They have a bank account for the 401k. And in the portion that's allocated to the Roth, they have some cash just sitting there. And he says, earning, in caps, very little interest. I see savings accounts at other banks earning 3%. Wow. The problem I have is they will not use an EIN number to set up those accounts. They want Social Security numbers or an ITIN. If I say that they are, this is a solo 401k plan, they treat it like a deposit and contribution, and it freaks them out. I added those words. You're right, Joe. The banks, you cannot say, and I'm going to make my first comment, let Matt comment. He knows this better than me, but do you have any recommendation for banks that will work with a solo 401k for CDs and things like that? Okay, my first point is people. If you set up a solo 401k or even an IRA LLC, when you go to the bank, if you say the word retirement account in any form of the sentence, when you're talking about this bank account, their brains will explode. You have to be very careful how you say it. It's not that you're doing something wrong. Banks aren't just built for this. Rarely does someone walk into the bank and go, I'm opening up a bank account for my 401k. Their brains go, who are you? Are you from planet Mars? They don't do that. Now, So my first point is, people, be careful and have a good sense of what you're trying to accomplish when you go work with the bank. And there's more to say here. What's your first response?
The first thing is large banks like Wells Fargo will pay you nothing for deposits. They don't care who you are. If they have too many deposits, they don't pay for them, period. So you want to get to small banks or banks that offer these. Now, if you go Google high interest savings accounts, what's going to pull up is opportunities only for individuals. They specially will offer these like promo rates or high interest rates specifically for individuals. That doesn't mean there's not high interest savings accounts. Let me get to that. But a lot of like online places, or if you're looking at like NerdWallet or the top searches that come up on Google for high interest savings accounts, you're going to see they specifically, those banks only do them for individuals. They want a banking relationship with you. They don't want someone just chasing yield that's going to bounce from bank to bank. So they make it only for individuals. Now, what I would do is I would go to the banks, smaller banks is what I would do, Joe, and look for some of those in your area. And I would just open it up in the name of the trust. Your 401k is a trust. It's the, XYZ retirement plan trust. Just say, hey, I have a trust. When you say 401k, a lot of banks think retirement accounts and these are to the retirement account department. You don't need that. You just need a bank account set up in the retirement plan trust name that can get some yield on this cash that's just sitting there. So that's what I would do. I would look for just a yield product like that. And so one thing we're going to be adding is an easier brokerage account option at Directed, where you might have some options there on just some other stuff you could buy if you just want to get some yield while cash is sitting. Because Wells Fargo is the last place you want cash sitting.
Yeah, okay, and I think, Matt, just at the very end of that, you hit the heart of the question. Folks, what's going on here? Joe has some cash that he hasn't deployed yet in his dream-directed IRA 401k plan. He may be thinking, I'm going to do a promissory note or a real estate project or a flip or a startup, but he's just got cash sitting there. And so Joe's like, what do I do with this cash? Well, I'm waiting to deploy, because he's just waiting to deploy, which is great. And so I think this is the opportunity to really look at the brokerage account, the option at Directed, and put it in some no-load ETFs or some really liquid mutual funds or ETFs.
Or even just a money market fund.
Yeah,
if you just want yield and interest. I mean, the ETF, who knows, the stock market's
when you say the word savings account, I just cringe. It's terrible out there.
There are high yield savings accounts right now, though. Like, banks are paying for deposits, finally.
Yeah.
It's a new thing, I know.
But anyway, I think this is a quandary, and you want to really look at your 6-month, 9-month, 18-month deployment plan of your retirement account. And just know that this is a kind of a holding tank situation. Get on the chat at directedira.com, talk to the team there and go, hey, tell me about the brokerage option. Can I get this 401k working for me, at least in some sort of no-load feature? And we've been using Titan Bank. There's a bank, right?
Yeah, I mean, I don't know that they pay for deposits.
Oh, gotcha, yeah.
So I'll just be honest. I mean, maybe, but
yeah.
They might have CDs or stuff that you could do, of course, but I would just look for some of the small banks. The larger banks that have high yield accounts, again, usually only allow them for individuals. So, but you can get it. But don't say Roth 401, solo 401k. Yeah. Just say trust
account. Yeah, there you go.
For my trust.
Okay.
All right.
All right, your question.
All right. This question is from Tom in Texas. We got a lot of Texas questions. We just had Joe from Texas. Now we got Tom from Texas. Okay, Tom.
I don't think he's the only Tom in Texas either. So no, I'm sure.
Tom says, I'm a little more. This is interesting. He sets this up nicely. Okay, he's trying to don't freak out by my question. He says, I'm a little more cautious by nature. I'm always looking for exits wherever I go. Okay.
Jason Bourne.
Jason Bourne, yeah.
Okay.
He knows that he can run a minute, a mile flat before his heart rate goes above
back always level. Up against the wall? Yeah. I'm with you. Okay.
All right. He knows that the most likely place for a gun is behind the bar.
Yeah.
And that the guy close to the exit over there looks like he can handle himself.
Yeah. Wow. That was impressive. Born Identity, folks. Weekend show. Okay.
Good flick. All right. It says, so please understand this isn't directed at any company in particular. He says, what happens if a self-directed IRA and the custodian has financial trouble? The FDIC protects bank deposits. The SIPC protects brokerage accounts. If I have precious metals in a self-directed IRA, is there an entity or process to help me regain possession of those assets if the custodian has financial trouble? Ooh, great question, Tom.
Is he talking about crypto or is he talking about precious metals? I think it's code for crypto. Because we're talking about Voyager and the...
Well, let's hit that separately.
I don't know. Okay.
Let me answer
precious
your question,
first.
Tom.
Okay.
I mean, this is a common question we get.
Yeah.
So let's talk about crypto with FTX, the golden child, going down the drain. Let's hit them next. But, all right. For a self-directed custodian, what you want to have and make sure you are using a trust company. There are companies in our industry who are not licensed, who are not regulated, who are not audited. There is no one looking into them but themselves. They're called TPAs. There's lots of them. They have hundreds of thousands of accounts in our industry. They might have your precious metals, Tom. If you're using a company that has the word trust company in the name, you know at least one thing. They are licensed. They are audited because they have to be as a part of their license. And they have some state bank examiner that goes in there and looks at their stuff. That's what we do at Directed. We use RSM, who's a top, I think they're like the number 5 or 6 largest CPA firm in the world. They work with banks. They audit us on a regular basis. We have the banking department in Arizona that comes in and examines us every year. Okay, we have another separate CPA firm involved too at an audit level. And so that's the process of a trust company. So if you're not using Directed, make sure whoever you're using is actually a trust company. Now, if a trust company fails, and this is important for the crypto discussion here in a second that I think we should have too. If a trust company fails, their assets should not have been touched. The trust company has to have its own separate business accounts and operations from its trust company assets. So your assets are not mine. At Directed, we can't touch your assets. Your precious metals, we can't touch it. We're not like a bank that's going to take your deposits and loan it to someone else, and that's why the FDIC is involved. We can't do anything with your assets. We are holding custody of them only for your benefit. If we go bankrupt, or for whatever reason in our business, would never happen for us because we're amazing, we're doing a great job, but let's just say it happened, or a company in our industry, the assets of the trust company are not assets that creditors can go after. They're your assets. We just hold them as custody for you. So that's the difference. FDIC is really there because the banks take your deposits and lend them to someone else. So if that person they lent the money to doesn't pay the bank back, that's where the FDIC comes involved, and there's all these rules on the leverage ratios that banks can use and such. But for an IRA custodian, I hope that helps for any assets. That could be your precious metals, your crypto, your real estate, your LLCs, your startups, your syndications. It's all the same. If it's a trust company, they are only holding custody to that asset. They can't be touching it. It's not something a creditor of the business could go after. Okay.
I was just clearing my throat to talk about this next question, not to comment, but I...
Do you want to talk about the Voyager and crypto?
Okay. Yeah, I did open that can of worms. I would just say this, that when you are investing in crypto right now, you are not getting FDIC insurance on that, period. No matter what crypto custodian you use, or certainly not a DeFi wallet or a MetaMask wallet. You're out in the Wild West. At the same token, you have to keep in mind, people, that this quote-unquote FDIC insurance and all of that is a little overrated in the sense that really that's just protecting you from Wells Fargo going under. You know what? If they were going to go under, 2008 showed us what the government's going to do. Banks are not going to go under. It would undermine the entire stability of the country.
And when the small banks that do go under, it happens every year, the FDIC makes a big bank take them on, or they make them merge with someone else.
Yeah.
So it's just, too big to fail has certainly happened. Too small to fail happens too every year right now with the small banks.
Yeah. So if you're saying, well, I only want to invest in things that have FDIC insurance, or some people, when you go out and buy stocks, or you go out and buy into a startup, you're going to buy real estate, you're not getting FDIC insurance. FDIC insurance is just for cash in the bank per se. Yeah. I mean, that's really, so if you know how to make frickin' money in crypto, or in the metaverse, or with precious metals, or with real estate, or with notes, go freaking do it. Don't think you've got to structure it in some way to have FDIC insurance or some. Now, are there going to be crooks out there? Absolutely. You could get with a bad real estate and property manager. You could get with a bad crypto custodian. You could get wallet manager, whatever. So you have to do your due diligence in those areas, but there's just never going to be this government safety net that you're going to not lose your money if you're dumb. You're going to lose it. Now, if you want to put your money in the bank and get a 1% CD with FDIC Insurance, knock yourself out. But you're making 1%. See, these guarantees or security come with a cost. And I think all of you listening are smarter than that. You're better than that. So I would just say, don't focus on that. You're focused on the red dress and the matrix. Move on. Go freaking, all right.
Yeah, what I would say is for those with crypto assets, and this is you got own in a retirement account or not, this is really important. There's a reason we use Gemini Trust Company for our retirement accounts. There's a reason a lot of people use Coinbase, which has a trust company. When your assets are at those types of institutions, they hold their assets separately than their own business assets. See, when people are using FTX, Voyager, these were not trust companies. You were basically lending and staking your assets to these companies. You were buying through them, and you could hold them. But when those companies failed, your assets started becoming at risk. So I hate to say it. I know a lot of people love DeFi, but what we've realized is some of these companies that try to operate in the DeFi space, they don't want them regulated. They don't like a company like Gemini because they're regulated. They're licensed. They got the New York banking department in their stuff. Well, turns out that can sometimes be kind of helpful. And those are the companies that are standing. Coinbase, Gemini, the ones that are regulated, that are trust companies, licensed, audited. Frankly, they're the ones that haven't had the problems.
Yeah, and let me make one more crypto industry comment. And I want you to know where I'm coming from. I own cryptocurrency. I mine. I own NFTs. I think there's a huge and bright future for this industry and this type of wealth. Do I know when it's going to hit? It could be at the end of my lifetime. It could be next year when the next round of increase goes. I don't know. But I think it's here to stay. The government's regulating it. It exists. It's not going anywhere. So know that I'm coming from a supportive place when I say this. We're in for the long haul in this space. And it's so easy to get caught up in the rhetoric of anti-government, the IRS isn't going to find me, I'm DeFi wallets, all I'm doing is setting up these wallets with an email, they'll never find me. And then you want your cake also, and I want security, and these guys are rug pulls, and they're scam artists, and there's this, and I want protection, and you should be more legitimate, and oh my gosh, the government should go after him. What do you want? You can't be in the, tombstone running around with your gun on your hip, but then when things get bad, you want to be, I want the marshal by my side.
You want Wyatt Earp to show up and save you.
That's right. I want Wyatt Earp. Well, you can't have both. And so I think what I'm trying to tell my young people that I know in my circle of friends and also everywhere I can online and Twitter spaces, the legitimacy of cryptocurrency is a good thing. Know that the IRS is going to tax you when you make money. Know that it's a real asset. You can lose it. You can win it. You can grow it. Embrace that and try not to be too conspiracy theory oriented. Just own it. And it's okay. It's cool. You're going to make a lot more wealth playing by the rules than trying to play in the fringes and off the grid. It's not worth it because when you get burnt, you're pissed. Well, you chose that path. Anyway, for what it's worth.
I like that.
Did you like that?
I like that. That was fair.
It's fair.
That was straight down the middle. It might have been some tough love for some of you, but I liked it.
Tough love.
Okay.
Okay.
Are you up or me?
I've got a question here.
Okay. All right.
Okay. Now, this is a tricky one.
I got a good one coming up.
Yeah, this is a good one, too. I want to hear some of these dumb ones that you were just throwing someone out.
I skipped those.
Oh, you did?
I skipped those.
You're not going to call them out? Okay. Jane in New York City, her phone number? Okay.
I'm sorry.
Okay.
I'm sorry.
All
It's
right.
my job to make you smarter, okay? It's our job to help you know the right questions to ask.
Yeah.
So.
Okay. New Mexico. That's their handle. Love the show. Thank you very much for your questions. I would like to better understand the actual cost of doing a side door solo 401k for real estate investors. And then they wrote, New Mexico wrote a big old paragraph here. Now, but there's some golden nuggets in here. And so I'm going to kind of truncate this or paraphrase some points. First, what is a side door solo 401k for real estate investors? And New Mexico points out who they are. What they are is they're a rental property investor. That's what they do full time. If you just have a bunch of rental property and maybe even a day job, but you really have no side hustle with ordinary income. You got 5 or 10 rentals, 10 or 15 rentals. You've got some cash flow. You're building a rental portfolio, and you look across the horizon into that next green field, and you're like, all these people are frolicking around with Roth IRAs and 401ks, and you're like, they look so happy over there.
Yeah.
I want to be in that.
They are.
They are. And you're like, the grass is greener over there. I can tell. They've got retirement accounts, and I want one too. But when you just have rental income, you cannot fund a solo 401k. You can still do your Roth IRA, knock yourself out every year, do your 6 or 7, love it. But if you really want to double down on a retirement account when you're a real estate investor, that's where the solo 401k comes in. So what you do with the side door strategy is you open up an entity to create a solo 401k, and that entity becomes the manager of your rental properties. Now, we would never recommend this typically for asset protection or any other purpose than this. It's an extra cost. It's kind of a headache. But if you want to throw down some cash in a 401k, it's the way to do it. It's the side door to getting a 401k. All right, now I'm going to just truncate this quickly. We could do a whole show on this, damn it. Is New Mexico says, well, don't I have to pay FICA on my salary in order to fund the 401k? I got to set up an LLC. I got to set up a solo. Yeah, there's some costs there. But when you can throw down 10, 20, 30, 40 grand into a solo 401k, and he says, I want it to be a Roth 401k. Great, better yet. But he says, these costs, is it worth it? Well, if you've got the money to invest and save, I think it's good to diversify so that all of your wealth is not tied up into rental property entirely. You've got a Roth 401k that's protected from lawsuits. Yeah, you're going to pay 15% in FICA, but people, you'll never pay tax on those investments again. It can grow tax-free forever. Forever, Smalls. So we want to, so I think it's not worth it. If you're going to just do 5 or 10 grand, not worth it. I wouldn't do it. You want to throw down 10, 20, 30, maybe you're married. I think he said in here, or he or she said they're married. Now we can double even further down on that money.
And do it multiple years, continuing it on.
Yeah. Don't worry about the real estate profession. He throws out the QBI. I want the QBI. Don't worry about that. Just say, I want money in my 401k. I want it to be a Roth. How much does it cost to set up? I'm going to have to take a salary. But once the money's there, you'll never pay tax again. I like it kind of the break-even point of 20 grand or more. I think, and you're committed to doing it for 2 or 3 years. Really work on building $100,000 or more in a solo Roth 401k. Ooh. Man, that grass is green.
That is great.
Okay. That's what I'd say.
I like it.
Okay.
Okay.
You concur?
Nice. I concur.
Okay.
I like it.
Right.
Remember, KQS Lawyers and It Directed, we still have our special going on for solo 401ks. So get over there, kqslawyers.com. The special is right on the homepage. Save some money on the setup of that. Get a consult with one of our amazing attorneys to help walk you through the process. Make sure you're doing it right. All right. This question is from Bob Darth Lord in Arizona. Wow. You know what I love a little bit more than a Star Wars little reference is a Spaceballs reference.
Oh,
you saw Spaceballs, right?
No,
you never saw Spaceballs?
I don't think so. I'm more of the one with Tim Allen. What was that? The spoof on Star Trek?
Oh yeah, I don't know
Galaxy Quest.
Yeah.
Oh, I love Galaxy Quest.
You gotta watch Spaceballs.
There's
It's got
Sigourney
Rick
Weaver.
Moranis and I mean it's anyways.
Okay, I'll do Spaceballs.
What's the guy that Mel Brooks? It's the Mel Brooks production. I don't know. So the character in Spaceballs is Dark Helmet. Anyways,
so there's a little something going on. Okay, all right.
But Bob, great question here. He says, I have a self-directed IRA that owns an LLC. To invest in a crypto project that requires KYC, that's know your customer, such as staking, do I have to use my entity information or can I use my personal info? I know some of the big places will eventually recognize an LLC, but some of the smaller ones do not yet. The LLC has its own wallet in its name. All right, great question, Bob. So there's a mixed answer here, and that's kind of a problem with where the industry is at right now in crypto. Yes, you could use your personal information with one of these staking places to get through their KYC because they don't have a KYC for businesses. But you know what that place is probably using that personal info for besides KYC? Tax reporting. They don't know you're an LLC that's owned by an IRA. To them, you're just Bob Darth Lord. And here's your social security number. And, oh, we're going to take that social, and when you make money with this staking, we're going to send tax reporting to the IRS off of it. And that's going to start happening in 2023. As we know, crypto tax reporting is going to have to start happening by those who are in the business of providing crypto services. So I would watch out, Bob, in that scenario where you're using your personal information and that's the only info you're putting. Now, even if you have an LLC, sometimes you got to put your personal information down as the beneficial owner of that at the end of the day for KYC purposes. So, but the places that have the business accounts, the LLCs and such, those are treating those as separate things. Your social is for KYC, your business information is for the tax reporting, which they use. And so while it is only the bigger ones that have those, there is more certainty there that your tax reporting is going to be right. And I'll tell you, this is one of the things when I speak somewhere, someone comes up and walks up and says, hey, I got a 1099 from XYZ crypto place. It's to my personal social, but it's for my IRA LLC. What do I do? Well, can you talk to that place and have them reissue it in your LLC's name? Unlikely. So, so I'd be careful, Bob, on those smaller places where there's no information going on the LLC or the LLC's EIN. Okay.
I'm trying to gather my thoughts here on this next question because it doesn't directly relate to retirement accounts, but it's about retirement. And I think it has there's some important concepts here that relate to investing in real estate with your retirement accounts. So if you'll give me a little latitude, I'm going to go for it. The G Machines put it in the retirement plan question section, but it's not a retirement plan. It's about retirement, which, again, right, closely related.
It's in the hemisphere.
Yeah, I think here's my big picture point of view is that all of you listening should have some rental holdings in conjunction with your retirement accounts. And your retirement accounts may have some real estate holdings as well as some type brokerage type accounts or notes. So any of you that are planning your retirement in a vacuum and you're only doing one type of investment or one type of tool to get there, I think that's very scary. I think that's a little reckless. You want to expand your horizon. I know it can be hard to learn new things and whatever you're doing is working, but the hammer works for you. Well, one day the hammer may not work. You know, you got to learn there's some other tools in the toolbox. So the question is, and I'm not sure if he's talking about his personal residence or a rental property. At one point, I think it's personal residence. The next, I think it's rental, but I'm going to answer it both. He says, so we plan to pay off our mortgage within the next 2 years. Okay, now I thought he meant his personal residence, but again, we'll see. My wife wants to sell and move, which means personal residence. I want to retain the property. We have a lot of upgrades on it now. And so I'm thinking he wants to turn it into a rental. She's like, let's sell it and move on. We want to put everything we own in a trust and create passive income from the rental as long as we can. So I think he's wanting to keep this as a rental once it's paid off. Pros and cons. I feel in the long run, it's better to keep the property. I can perform nearly everything as a contractor-wise as needed to expand into more rentals as we create more real estate portfolio. Okay, I think there's some really deep points here that G Machine is bought into that I'm going to be honest, I don't agree with. So, first, when you pay off a mortgage on a rental property and you just want to keep it as a rental, guys, you move from an investor to a rent collector. If you look at your real return on investment or your cap rate or your cash on cash return, if I've got a rental property worth $300,000 paid off and I'm only getting maybe $2,000 a month in rent, $24,000 a year minus property taxes and this and that, your actual ROR or rate of return might be 5%. But you think it's a great deal because it's a piece of real estate paid off. Be careful holding paid off real estate when you're in those production years. You could take that rental property, sell it, and buy 3 others, maybe even in a 1031 exchange. You could do an equity strip and go buy 2 other rentals. I love Dave Ramsey about staying out of debt, and especially consumer debt and credit cards. But to pay off everything you own and just sit back and collect rent, that's not the best rate of return. You've got to look at what can I do with that $300,000 otherwise, well, that's paid off and I can work on it and I just want it there. You know, that's a target for a lawsuit. Are you kidding me? You get in a lawsuit, the first thing they're going to go after is your paid off rental. And last point, you say, we're going to put everything into a trust and create passive income. Everything you have should already be into a trust. You don't create a trust to create passive income. Any of you out there that are married, single, young, old, own a small business, own real estate, kids or no kids, you need a revocable living trust. The trust isn't the mechanism to build wealth. It's your strategy that builds wealth. And if you're paying off real estate to just sit back and collect rent or sit on a home that's worth $500,000 paid off, ooh, be careful. I don't know.
Yeah.
Just some fundamental issues in there that...
Yeah, a couple other things I would think about, because I think they're talking about a home that they're going to move out of that the wife wants to sell. Because my wife wants to sell and move, so I presume they live in it, and he wants to retain it as a rental. And it sounds like, but
it's paid off.
Yeah. So a lot of times the home you live in is not a great rental. It's not the most productive rental. It might be a great home, but it's not the most value in terms of the rental income you can get from the value of the property. And you might just live in a market that's not a great rental market. Arizona is classic. It is not a good long-term rental market. California, not a good long-term rental market. If these properties are in California, for example, this home, the equity you can get out of that to go buy rentals somewhere else is going to be way more cash flow in retirement for you than it is just keeping a California property as a rental because of the value of the property. The second thing I would consider is if this is a home, you might be able to sell it and get the sell of home exemption. Yeah. And you might have, you're married, $500,000 of tax-free income coming out of this that you go buy more stuff that kind of increases your basis now in the next purchase of these assets. So rather than doing a 1031 exchange or something like that. So I would just keep those two considerations in place. But I would be strategic about it. I think one misconception you have, and this is a struggle I have even with my assets is, and I remember one of my really successful clients talked about this to me was, I look at all my assets, not about what they're making, but what else they could be making. So if I've had a rental property that I fell in love with, or a home or rental, whatever it is, some asset I fell in love with, I need to look at that and say, what could I sell it for today? And what else could I buy with it? So look at this property you have, this equity, this value that you could get out. What else could you do with it that would make you more money? Now, I know you might think, oh, I can work on this property and,
it's got a lot of upgrades.
Yeah, I mean, we're talking about living off of this thing in retirement. You want the most yield, the most money coming in every month you can get. So focus on that. And
I like one word Matt said in his statement.
Only one?
Well, I'm going to comment on one word. Let me comment on one word Matt said. I agree wholeheartedly with everything you said. But he said the word love. Now, what that means is there's some feelings attached to this property. G-Machines, when you're looking at your retirement and your future, you've got to take the feelings that we have for certain assets out of the equation. You got to be able to look at this as numbers. What are the numbers on this? And you're like, I know, G-Machines, I can see it in here. Oh, I put all these upgrades and I know that backyard like the back of my hand. I did the sprinkler system. I did the fence. I love this property. Some renter's going to love it. I want them to love. Okay, get over it. This is your retirement. Look at the numbers. Chris Albin, one of our instructors at Renatus that we teach with once in a while, he's a real estate investor out of Chicago. I'll never forget when he says, people fall in love with the white picket fence. They buy rentals because they look cute and they see themselves living there and they over rehab and they put in granite countertops. And he's like, no. You're buying numbers. You're not buying a house. And when you're sitting on a house like this, you're sitting on numbers. And I know there's emotion attached to it, but you've got to just change that mindset. Now, I'm not saying you sell it or you don't, or where you deploy it or not, but just keeping it a paid off piece of real estate and thinking that's your best investment, I think I can win that argument. That's not going to be your best move. So,
love it.
All right.
All righty, folks.
You got another one? No other questions?
I think
I have one more.
Okay,
Are we wrapping it up? Okay, hold on. I got one more. And it's for military. You got to go, come on, military spousal benefits.
Have you previewed this question?
Hell no. Okay, oh my gosh, it's a book. Oh my hell. Okay, bless your Anastasia 13. This is a podcast where we answer some simple questions. It looked like literally a Word document here. let me say this, and maybe this is a good comment for some of you. And I know it's military listeners and annual limits and military members, and we have this and that. Maybe we do a whole show on something like this. But this is a good reminder for all of you sending in a comment for the podcast. Try to keep it to the point, distinct. And if you feel like we're going to give you advice on what your plan should be tomorrow, it's time for a consultation. Pay for a half hour. Talk to one of our tax lawyers. You get with one of them within 10 days, no more than 2 weeks. Usually we have a space. Get in there, talk about it, bring up this message that you wrote us, and they're going to answer it particular to your facts. And that's what you need. Us commenting in general here on the podcast is really helpful, and it'll help many of you in your consult, but don't take it as a consult. Get the call. So
it's a great question, actually. I'm reading bits and pieces of it. I just know we won't be able to fit it in, and it'll take a lot of explanation.
TSPs, Roths, retirement contribution, max out Roths while in a combat zone, max out contribution on my non-military job. This is great. And one of our tax lawyers would beat the crap out of this, and you'd love it. So, okay. Well, all right, Matt, you can wrap us up then, I guess.
Okay. All right. Well, thanks, everybody. Remember, get over to directedira.com/podcast where you can ask your questions for our next upcoming open forum episode. And get over to directedira.com for any of your self-directed IRA account needs. If you want the solo case special, remember, that ends in November. For any of those who want to get 2022 deductions, you've got to get the plan set up by the end of 2022, which means you've got to start now. You can start with the solo K plan at kkslawyers.com. We have the special going on through November. And we'll be back next week. Till then, stay calm, self-direct on.
See you next week.